All right, let's get right into it. We're talking about a company that is, quite literally, building the future of a nation. But when you're dealing with projects on a monumental scale, the risks are just as big. This is the story of Patel Engineering and what looks like a giant's gamble.
I want you to picture the biggest, most mind-boggling construction projects you can think of. You know, the kind that reroute entire rivers, carve tunnels straight through mountains, and build the highways that connect our world. Well, that's exactly where Patel Engineering lives. They're building the essential infrastructure, the very arteries that keep a country's economy pumping.
So first, let's look at the company itself. A company building India. They've been around for a long time, starting with a vision way back in 1949 and growing into the modern infrastructure titan they are today.
Okay, now for the first part of our story, the engine of growth. To really get a handle on the momentum this company has, you've got to follow the money, you've got to follow the numbers.
And we have to start with this staggering figure, over 16,000 crore rupees. That's not a projection, that is the value of confirmed projects they've already lined up. It's a pipeline of work that basically guarantees their activity for years to come. It's just a massive vote of confidence from their clients.
And what's really interesting is seeing what that massive number is actually made of. You can see a huge focus here, right? A whopping 64% is in hydropower and another 21% is in irrigation. So this tells us they're not just a general contractor, they are deeply specialized and have placed a heavy bet on India's future in water management and renewable energy.
And that bet, it really seems to be paying off. Just look at this trend. Sales are climbing and climbing steadily year after year. This isn't some one-off lucky break. It's a clear pattern of consistent growth, finally breaking that 5,000 crore mark in the last fiscal year.
And if you need one stat to understand their sheer dominance, here it is. Of all the hydropower capacity being built in India right now, Patel Engineering is involved in constructing almost half of it. Think about that. That's not just being a player in the market, that's being a fundamental cornerstone of the entire national energy strategy.
So you'd think they might slow down, right? Nope. They have a clear and frankly very aggressive strategy for what's next. They're aiming for another 10 to 12,000 crores in new orders. They want to keep their profit margins stable, and they're teaming up with other giants to go after even bigger fish. The goal? To push revenue growth past 15% a year. So far, this story is all about incredible ambition and success. But this is where things get complicated. Look at the most recent quarter. On the one hand, sales are up a really healthy 20% compared to last year. Fantastic news. But then you look at the other side. The net profit, the actual cash the company gets to keep after paying all the bills. It didn't just dip, it plummeted, down 73%. So how can you be selling so much more but making so much less? This is the twist in the tale. And that brings us to the second part of our story, and the big question, are there cracks in this massive foundation? We've seen the incredible growth, but now we have to dig into the red flags that some analysts are getting worried about.
Okay, first we gotta understand this concept, promoter share pledging. In simple terms, the owners of the company, the promoters, are using their own stock as collateral to borrow money. It's really no different from you taking out a loan against your house. The big risk? If the value of your house, or in this case, the company's share price, falls dramatically, the lender might get nervous and force you to sell to pay back the loan.
Now, with that in mind, look at this number. Almost 89% of the shares owned by the company's founders are pledged. That is considered a very, very high number, and it creates a serious risk. Any sharp drop in the stock price could trigger a wave of forced selling, which would, of course, put even more downward pressure on the stock. It's a dangerous cycle.
All right, next red flag, working capital days. This sounds technical, but the idea is simple. Imagine you're a baker. This metric is just the time between when you pay for your flour, sugar, and eggs and when you finally get paid by a customer for the cake you sold them. The higher that number, the longer your own cash is tied up in ingredients just sitting on the shelf.
For Patel Engineering, that number is 225 days. That's more than 7 months. It suggests a massive amount of their cash is locked up in their ongoing projects, paying for steel,
concrete, labor, long before they get the final payment from their clients. And that can put a serious squeeze on their day-to-day cash flow.
And finally, let's see what the pros are doing, the big professional investors. We're talking about domestic institutional investors, your big mutual funds, your insurance companies. Look at the shift here. A couple of years ago, they owned 15% of the company. Now, it's down to less than 5%. When the so-called smart money starts heading for the exits like this, it's often seen as a major signal that their confidence is waning.
So where does all this leave us? It leaves us right in the middle of a high-stakes balancing act. You've got this incredible nation-building growth on one side, but you've got these significant financial pressures and warning signs on the other. It's the ultimate corporate tightrope walk.
And this snapshot from just a few months in 2025 shows you that turbulence in real time. In May, they win huge contracts worth thousands of crores. Amazing. Then, in July, they lose a court case and have to pay out. But in that same month, they win another contract. And then they decide to raise another 200 crores in debt. It is a whirlwind of massive victories happening right next to financial setbacks and legal challenges.
Which leaves us with this one fundamental question. Are all these financial strains and risks just the cost of doing business? Is this what it takes when you operate at this colossal scale, literally building a nation from the ground up? Or are these flashing red lights warning us that this giant, in its relentless pursuit of growth, might be stretched dangerously, dangerously thin? That's the billion-dollar question.